Should you invest or pay off debt? Look, the gurus have it wrong. The talking heads don't know your situation and what's best for you. And look, if you get this wrong, it will absolutely rob you of life enjoyment and wealth. There's absolute bias and a one-size-fits-all mentality for advice on investing versus paying off debt. Again, if you get it wrong, it will cost you. This may be one of the biggest culprits for bankruptcy, divorce, and for sure financial stress. The number one reason listed for divorce is money. In 2008 and again today, one of the biggest reasons for bankruptcy is being over-leveraged. If you watch Dave Ramsey and Susie Orman, they say you absolutely should pay off debt at all costs, ignoring economics, inflation, and this great wealth transfer that's happening right now. Or if you listen to Robert Kiyosaki or Grant Cardone, they say you absolutely should invest and leverage, use debt for acquisition, ignoring investor DNA, peace of mind, and risk management. So, who's right? This is the personal part of personal finance. I don't know why they call it personal finance, since most of the time it should be called transactional finance, and people don't treat it as personal at all. But it really comes down to 5 factors and one simple equation. See, banks are in the business of leverage and debt. Anyone who thinks they don't have time to manage the money, well, they may want to consider paying off debt, but to know for sure, let's dive into these 5 factors. The first factor is what I would call the peace of mind and economics factor. See, how do you feel and operate when you have loans? Does it keep you up at night? Does it create frustration and contention with your spouse or significant other? Is it something that you just absolutely, can't get over and you just wish that it was gone, and if it were, you'd feel like that weight is off your back? So you got to think, how does this impact your family or others with your financial choices that are impacted by those choices and decisions? And even think about things like the economics of an amortized loan that are close to being paid off. What do I mean by that? So say you have a 15-year mortgage and you're 11 years into it. You only have 4 years left, but that payment every single month has stayed the same, even though the balance has gone down, because that's what an amortized loan is. And maybe paying that off would free up way more cash flow than if you invested those dollars. So all this to be said, this comes down to personal preference, personal economics, and your specific situation. Part of what helps is something I would call your cost of money, also known as opportunity cost. Your cost of money is what can you get with your money when you invest it? What is that from a safe and more secure standpoint, net of all your costs and expenses? That's your cost of money. Or for others, cost of money is that really high interest rate you have on a loan that burdens you. Maybe it's this crazy number like 22% on a credit card, or even ones as high as 29%. That's crazy, right? It should be usury. But that's your cost of money, because anytime you don't pay down that loan, it's not just costing you $1 when you spend that money, it's costing you $1.22 or $1.29, depending on the interest rate. So cost of money is, if I pay cash for something, I forfeit the right to earn on that cash. And so what am I forfeiting? What interest could I earn? See, there's always an interest cost, whether we pay cash and forfeit the right to earn it, or whether we borrow it and then we pay for the right to use it. There's an interest cost all the time. So our cost of money is kind of the economics behind everything. What's your actual rate of return after your fees and after your taxes? That's your cost of money. Or what are you paying to borrow that money? But peace of mind, that's a lot more simple, yet even probably more important. Peace of mind is, if I'm in scarcity because I borrowed money, I'm over leveraged, and I think, well, this is the way that these gurus talk about, that peace of mind being decimated destroys my overall quality of life and becomes one of the factors that you really have to consider. So the first one is, what's the peace of mind for you and those you love? And what are the economic considerations? If you're almost to pay off a loan and you just keep making that monthly payment, well, what if you just took some funds, paid that off, and you freed up that cash flow? That's an economic consideration. Peace of mind consideration is, what do you feel like if that loan is paid off? See, Dave and Susie always think, oh, if you pay it off, you're always going to feel amazing. But you know what? I've had no mortgage before in my life. I've had a mortgage in my life. It really doesn't matter. And even to my wife, it doesn't matter. And right now, our mortgage is at 2.75%, where interest rates are north of 7%. So look, I've got pretty inexpensive money. But if my wife was like, I just can't sleep, I feel so frustrated that we have this mortgage, it feels risky, then I might want to consider paying it off. But because we both have this peace of mind having that, knowing that we have enough cash to pay it off, well, that peace of mind factor is checked off. So now it's economics. Can we do better than 2.75% with relative certainty? And the answer for us is yes. Well, that takes me to the second factor here, and this will help you answer that for yourself, is what is your investor DNA? Where would you invest the money if you have it? versus paying off the debt? And does that investment create cash flow today? Because most people investments are locked away for 30 years in a retirement plan, and they don't know whether it's going to work out until they get way further down the road. And then the question with Investor DNA is, which by the way, Investor DNA is your values, it's your abilities or competencies when it comes to investing. It's the drive that you have and the interest you have in that, and maybe passion that's involved with it, and it's focus. So some people are better investors when it comes to real estate than others. Others are good at acquiring businesses. Some are maybe good at the stock market, most aren't. Maybe some are really good with tax liens or with cryptocurrencies. I mean, it really depends on where you're investing and what type of investor you are, and understanding your investor DNA. Hey, I know I'm interrupting, but it's because if you go to garrettgunderson.com/quiz, you can figure out your money persona. When you know your money persona, you'll be able to make better choices when it comes to your finances, understand where you've made mistakes and missteps and what was the psychology behind that, and really improve how you view money and how you work with other people with different money personas. So garrettgunderson.com/quiz, no charge, discover your results, and go ahead and comment and let us know what it was. And for some people, volatility with investments drive them crazy. It infringes upon that peace of mind that I talked about before. So what return can you sustainably get? What's your investor DNA? How can you become a better investor? And if you have uncertainty with that investing, or you have frustration around if it doesn't quite work out, well, that takes me to the third category, which is risk management. So the first thing is, what are the economics behind this and the peace of mind? For someone that's trying to put money in a retirement plan and they hope with their fingers crossed they might get 10%, yet have a 15% interest rate credit card, the economics doesn't make sense. Pay off that credit card. It'll improve your credit score, which could help you out overall. It'll probably increase your peace of mind. And ultimately, you're doing better by saving 15% than trying to earn 10%. So that's economics versus peace of mind. Second is investor DNA. For me, my investor DNA leads to building videos like this, writing books that I do, businesses that I'm involved in. That's my investor DNA. I'm not great at most real estate. I'm definitely not great with the stock market. So I'm not really invested in those areas. My interest rate, the only one I have is 2.75%. I can use something called cash flow banking, and I can get more than 2.75% with high degrees of certainty. So I still have that cash. I have access to that cash. I'm doing better, so I'm creating something called arbitrage, borrowing at 2.75 and maybe getting 4%. That is a positive return. But this comes down to risk management. What are your chances of success with your investments? If you're taking a lot of risk, you're going and buying shit coins, like Dogecoin or most cryptocurrency coins outside of Bitcoin or maybe even Ethereum, depending on your philosophy and belief in Web3. But there's so many different coins that are out there that were built upon hype with these ICOs. People are buying them thinking they just buy and hold and it was going to skyrocket and they're going to make so much money. Their greed gland kicked in, and it wasn't an investment at all. It was completely gambling. So much of that happens within trading within the stock market. People buy options trading programs and click their mouse and hope that they're going to get these huge returns, 5% a month, and they find out they lose all that money. Risk management matters. See, if you were to lose with the investment, what impact would that have on your mindset, on your life, on your relationships? And have you thought with your investments how you can protect your downside? See, if you could earn the same interest rate as you're paying with a loan, well, maybe paying off that loan is the best thing to do because it's certain. You know you're saving that, where the investment might be uncertain. And that takes me to the fourth factor, which is your time management. See, how much time does it take to invest in real estate? When I had a lot of real estate properties, I had to talk to the property managers and the maintenance people, and I had to talk to the attorneys to set up the legal documents. I had to talk to the banks to set up the loans, and I had to go through all this process of gathering my taxes and managing my credit score, and I was doing things I didn't really enjoy, and it took a lot of my time, which had an opportunity cost from doing the things that I did enjoy and the things that I wanted to spend my time doing, but I was so caught up in investing that I wasn't managing my time effectively. So how much enjoyment do you have with the investments that you're making? See, paying something off just frees up that time. Investing requires stewardship, and is it worth your time? So what other things can you do with your time? So as we're considering, Should you pay off debt or invest? It comes down to what type of investor are you? What is your investor DNA? What return could you earn versus what do you save when you pay something off? What peace of mind factors do you have? What kind of risks are you facing? And finally, before we get to the solution, the equation that's going to answer it for you, one of the things that is an argument towards borrowing or leaving your loans out there is inflation. See, inflation hurts with most things, but it actually helps with debt. The payment just feels like less of a burden year by year. If inflation is there, and we're like, oh, in 1980, $1 in 1980 acts like $3.70 today, well, guess what? That just means that a loan that you've had for 10, 20, 30 years, each and every year, that feels like less of a burden, less of a loan, less money because there's more money in circulation or more money that's been printed. So leverage in those situations, like can help you acquire assets, and it helps you have that inflation may push the values of real estate up over time, and leverage by borrowing to get that property might give you a lot of opportunity for growth and equity, but it can also increase your risk. Leverage is a scary word for most people because if we leverage our money by borrowing without the knowledge behind it, we gamble. And that gamble can end up being something that leads to bankruptcy, something that leads to a loan that you have to make a payment on, even though the asset isn't worth as much. We saw that in 2008. People had so much high appreciating property, and everybody starts to get in at the wrong time because the wealthiest people go, well, when everybody's in panic, that's the time I'm going to acquire. And when everybody's in greed, that's the time I'm going to sit on the sidelines. Yet there's a collective consciousness where people get so excited, I got to do it because I'm missing out. I got to get into the crypto now. I got to get into real estate because all it is doing is going up. And then all of a sudden it starts to go down. And if you borrowed to get into that, that can be a major burden with crippling consequences. Here's the solution, is to understand two things, your indexes. One is your investment index and the other is your cash flow index. Let's begin with your cash flow index. If you're borrowing money, if you have any loan, I want you to look at your cash flow index, which is take as your loan amount and divide it by your monthly payment. So your loan balance divided by a monthly payment creates your cash flow index. If it's a number less than 50, you have a very inefficient cash flow index. If it's higher than 100, you have a very efficient cash flow index. If it's between 50 and 100, you're kind of in the consideration zone of should you restructure, refinance, or is it like that's where you really got to look at your investment index, which is the next thing I'll tell you about. But you want a really high number because what it means is you've borrowed money, but you don't have a very high payment or it's not really negative consequence on your cash flow. So longer term mortgages can be like this, but some people go, yeah, but what about the high interest that you pay on a mortgage of 30 years or interest only over your lifetime? But remember, we always pay interest, whether we borrow money and we pay for the right to keep that money, right, or to use that money, or whether we pay cash and we forfeit the right to earn interest. It comes down to what you can earn versus what you pay. Again, if those numbers are similar, maybe just pay it off and have the certainty. If you have arbitrage where you've borrowed at a much lower rate than what you're earning, you have to look at the time it takes. You got to look at the risks that are involved to understand who you are, to understand your situation here. So the investment index is when we make an allocation towards investing, what is the amount of money that we put in that investment over time divided by the monthly cash flow? Now, most people have no cash flow when it comes to retirement plan or when it comes to their mutual funds because they're just reinvesting, thinking that compounded interest is what's going to be their solution and their savior. But ultimately, I'm in the game of economic independence where you have enough cash flow from your assets to cover your expenses because now every active dollar you earn can build more assets. It's an unfair, amazing advantage. So your investment index, if it's a really high number, it means you're not getting much cash flow. Let's go back to look at the previous example. Cash flow index, when you are the bank, you want a loan number for the person that borrowed money because it means you have a lot of cash coming in relationship to your investment or the amount of money you put out. When you're utilizing funds from a bank, you want a high number, right? They want the low number, you want the high number because it means that you don't have a lot that you have to pay every month for the privilege of accessing that money. So it's the same when it's the investment index. You want a low number. You put some money in there, but you're creating a high amount of cash flow off of that, which creates a low number. Now, if you have a high number, it means you have not that much cash flow for the money that you've allocated. So when you look at your cash flow index, you want a high number. When you look at your investment index, you want a low number. It's what are you operating as? The investor or the borrower? That's the question. So what impact would paying off a loan have on your cash flow? If you have a low cash flow index, you might want to pay that off. What amount of cash flow could you create by investing? You want a low number on your investment index because it means you've got a pretty strong cash flow from the amount you've allocated. And the spread of what you're borrowing versus what you're earning during high interest rate environments might be more difficult. If you could borrow money at 1% and earn 2%, that's a 100% markup. But if you have to borrow money at 7% to try to earn 10%, that's only really a 30% markup. We might have to check my math on that, but you know what I'm saying there. So what I'm looking at here is these 5 factors are critically important. Peace of mind and economics. How do you feel about it? And what are the numbers? Number 2, your investor DNA. What kind of investor are you and how can you become a good investor? 3, how do you manage and mitigate your risk so it's more sustainable? 4, how much time does it take when you're making those investments and what other things could you do with your time? And inflation starts to make that debt feel like less of a burden over time. So who's right? It comes down to you. Personal finance is very personal, and that's why we have this YouTube channel. Ask your questions. I like to answer it. Often I'll answer it in video form. But I think going to the lowest common denominator, if you always pay something off no matter what, that minimizes opportunity. On the other hand, always thinking that leverage is the answer. We've seen people like Rick Edelman, it's always have a mortgage, or Robert Kiyosaki, leverage debt. It depends on you, the person, and your investor DNA. So find out your cash flow index with your loans, compare it to your investment index with where you're putting money. And if those numbers are the same, well, then it's a choice. If you have one that's much higher than the other, then the choice is clear. If you have a very high investment index and a low cash flow index, pay off the loan. If you have a very high cash flow index and low investment index, continue to be an investor, but take into consideration risk, take into consideration the amount of time that you put into this, and ultimately what opportunities are out there for you. All right, so now we've kind of cut through the crap, given you more information so you can make better and more informed choices. And if this video was helpful, I have a lot of videos that are around loans and have a lot of videos that are around investor DNA. So go ahead and click on through, watch the next one so you can become a much better investor and get to the bottom and figure out what the truth is when it comes to money.